Hey, how are you? I am going to go over what a loan estimate is and how to look at lender fees. So, if you are looking at a loan estimate or a CD, it's essentially formatted the same way. So, you can kind of use this as an example for both. So, a loan estimate is what you get right when you are applying for a loan and the lender wants to put the terms onto a contract for you to read and sign. So this will tell you your loan terms up top here. If you're refinancing or purchasing, it should be the same format. And then what type of loan you're getting. Your rate will expire at a certain time, so it will have a date and time for you to have to lock your rate and finish your paperwork. Now, the property value will show up here, and essentially, these tabs here are written so that it's categorized so you know what section is talking about what. This is written. If you look through it, most people can understand what's going on instead of just getting overwhelmed. I think sometimes when people think about finances, they start looking at this and they feel like they're not able to understand it, but it's actually written very clearly, mainly because people were getting confused when we were doing those subprime loans where a lot of people got into hot water for not understanding what they were signing. This has changed drastically, and you can see the font is larger. What can change, what can increase, it's clearly written here. So if you look at the tabs, they'll tell you what's going on in each section. So in this example, we are looking at a property that's estimated at $680,000. The loan amount would be $408. I'm sorry, $408,000 at 3.5% interest rate. The estimated monthly principal and interest is $1,832. You can read that, and this is really important. There's no prepayment penalty and no balloon payment. What this portion talks about is your escrow in pounds. So if the lender wants you to pay your property tax and mortgage insurance every month rather than annually, then they're going to give you a quote for what that looks like monthly, and that's an estimate as well. So the estimated closing cost is close to $12,000, and it's going to be broken down in the next page. So we're going to focus mainly on Section A to look at lender's costs, which is categorized right here. So when you're shopping lenders and you want to know if lender A or lender B has a better fees, then all you would have to do is look at the interest rate, and you want to look at their fees in Section A. So the processing fee goes to the lender, and then the point, and I'll show you how to calculate in a second, is what roughly is the commission that goes to the specific lender. So the processing fee would go to, for example, if you're working with Wells Fargo, would go to Wells Fargo, and then the $4,080 would go to the lender that you're working with. I'm not sure if the PIW, what it is. I've seen it sometimes, but I'm not a lender. But we'll skip over that for now. So how you calculate this would be 1 point is equivalent to saying 1%. So if it's 2 points, then you're paying 2%. 2% or 1% of what is the loan value. So you're going to take this number that you're borrowing, the loan amount, and you're going to, they've multiplied by 1%, and that is how they got that fee here. Now, the rest of it, why is it showing 11,919? The rest of it shouldn't be used to compare lender A or lender B, because Section B, Section C, all the way to Section G are fees that are sometimes fixed already, and it's not up to the lender to decide. So if one lender gives you a higher closing cost, it might not be because of their fees, and you want to pay attention to that. They might have estimated that your property tax was a little higher, and again, it's an estimate. So if they estimated it to be a little bit higher, it will get readjusted later to show more accurately what it is. So if you look in Section B, These are third-party fees that goes out, and some of them don't even apply necessarily if you're not in an HOA complex. Then you're not going to have some of these fees here. So actually, the closing costs that were quoted here should go down if it's single family. Section C talks about escrow and title company, and technically you can shop for those companies, and you could, but usually the best company to work with is the one that the lender has already established a relationship with, only because they usually get like a discount for using them frequently. And if you shop around, you're probably not going to save much more. Maybe one section would be $5 more expensive here, or $20 cheaper elsewhere. But overall, these fees are pretty standard across the board. So you're not going to see something crazy here. Then if you go over to section E, F, and G, these are already set. So the recording fees are set by the county and the city. So you don't really get to shop around for those. So if another lender had estimated this to be $600, it's going to pull your estimated closing costs up. Your prepaids are your homeowner's insurance, which you're going to end up shopping for. If you have a PMI or a mortgage insurance, then that's associated with your loan. And then if you have property taxes, they're also going to estimate that. And again, your property tax is not negotiable. So if they, again, put in a higher estimate for these, you're going to see your closing costs pulled up higher. And that might not necessarily mean that that lender has the worst rate than someone else. So when you are shopping for lenders and you're looking for fees, just focus on section A and the interest rate. And that's really all you need to look at. And when you get your CD, I know I had mentioned that. This is kind of the same way you read it, but when you have the CD, that's when your loan is right about to wrap up. You don't really get to, I mean, you can pull out if you want to, but it should be consistent to everything. The estimate should be a little bit better for your homeowner's insurance, because you'll probably have a quote by then. Then your property tax, you might have had a bill that you submitted to escrow, and then this way they can update that information. But I hope that helps you understand how to look at the structure of this document, because once you figure that out, then you can go ahead and compare rates. One last thing I want to mention is that you shouldn't compare rates with a friend that recently bought a house or refinanced, or that said, hey, we got a better rate than you. There's a lot of variables that are not going to match up with yours. So one thing to pay attention to is timing of when they got this loan. The interest rate changes every day. So maybe when they processed their loan, the interest rate was lower, and something had changed in the market. That's one. The other thing is their loan value. If they borrowed a conventional amount, which is a certain amount, they're going to get a lower interest rate. If they get a jumbo loan amount, that's going to be a higher interest rate. And then third is that you need to pay attention to actually your file, your debt to income ratio, your FICO scores. All of that matters as to what is the best qualifying rate that you have. So I don't think it's a good idea to start paying attention to that, because it's going to make people upset. They feel like they're getting cheated or they're getting swindled, and they don't feel like they're getting the best rate. The best way is to compare at present time to lenders, so you can see market rate for the same loan value for your same file, what is the numbers and what the fees look like. So I hope that helps you understand this document. It's actually very easy to understand if you kind of just look through it. It's written this way for your protection. So it shouldn't create too much stress. I hope you got a really great interest rate on your loan, and I hope that once you get the CD, you would be able to understand this. Have a good night.